In Chapter 9, we will cover the assessment of the risk of material misstatements to the concepts studied in Chapter 6. We will also cover an introduction into the 5th and 6th steps in planning the audit, which builds on the first 4 steps that were covered in Chapter 8. When auditors assess risk, they use a considerable amount of the information acquired and documented during the first 4 parts of audit planning. At the end of Chapter 9, you should be able to do the following. You should be able to define risks in auditing, distinguish the different types of risk assessment procedures, understand important auditor considerations related to the risk of material misstatement due to fraud, be able to describe the auditor's responsibility to identify significant risks, describe the audit risk model and its components, assess acceptable audit risks, consider the impact of several factors on the assessment of inherent risks, discuss the relationship of risk to audit evidence, and be able to discuss how materiality and risk are related and integrated into the audit process. Let's begin by discussing risk in auditing. Auditing standards require the auditor to obtain an understanding of the entity and its environment, including its internal control, to assess the risk of material misstatements in the client's financial statements. Auditors accept some level of risk or uncertainty in performing the audit function. As discussed in Chapter 8, the risk of material misstatement is the risk that the financial statements contain a material misstatement due to fraud or error prior to the audit. The risk of material misstatement exists at 2 levels: the overall financial statement level and at the assertion level for classes of transactions, account balances, and presentation and disclosures. Auditing standards require the auditor to assess the risk of material misstatement at each of these levels and to plan the audit in response to those assessed risks. The risk of material misstatement at the overall financial statement level refers to risks that relate pervasively to the financial statement as a whole and potentially affecting a number of different transactions and accounts. A number of overarching factors may increase the risk of material misstatement at the overall financial statement level. For example, deficiencies in management's integrity or competence, or inadequate accounting systems and records can increase the likelihood that material misstatements may be present in a number of assertions affecting several classes of transactions, account balances, or financial statement disclosures. Auditing standards require the auditor to assess the risk of material misstatement at the assertion level. The risk of material misstatement at the assertion level consists of 2 components: inherent risk and control risk. Inherent risk represents the auditor's assessment of the susceptibility of an assertion to material misstatement before considering the effectiveness of the client's internal controls. In contrast, control risk represents the auditor's assessment of the risk that a material misstatement could occur in an assertion and not be prevented or detected on a timely basis by the client's internal controls. Inherent risks and control risks are the client's risks, and they do exist independent of the audit of the financial statements. We will now move on to discussing the different types of risk assessment procedures. As first discussed in Chapter 8, to obtain an understanding of the entity and its environment, including the entity's internal controls, the auditor performs risk assessment procedures to identify and assess the risk of material misstatement, whether it's due to fraud or error. Risk assessment procedures include inquiries of management and others within the entity, the performance of analytical procedures, observation and inspection, discussion among engagement team members, and other risk assessment procedures. Management and others within the entity may have important information to assist the auditor in identifying the risk of material misstatement. Inquiries of those charged with governance, such as the board of directors or an audit committee, may also provide important insights about overall client business risks. While the AICPA auditing standards suggest that inquiries of those charged with governance may be informative to the auditor, the Public Company Accounting Oversight Board auditing standards require the auditor to inquire of the audit committee or its equivalent about risk of material misstatement. Inquiries of internal audit personnel may also provide important information about key risks to the business affecting not only financial reporting but also operations and compliance with laws and regulations that may increase the likelihood of material misstatements. Inquiries of internal audit personnel may also provide valuable information about the design and operating effectiveness of internal controls. The performance of analytical procedures may help the auditor identify unusual amounts, ratios, or trends that might identify unusual transactions or events having audit implications. Analytical procedures performed as part of the auditor's risk assessment procedures may include both financial and non-financial information, and they often use data aggregated at a high level. As a result, they may only provide a broad indication about whether a material misstatement does exist. Together, observation and inspection provide the auditor with a basis for understanding internal controls, which is an important input for the assessment of the risk of material misstatement. Auditing standards require a discussion among the key engagement team members, including the engagement partner, about how and where the entity's financial statements may be susceptible to material misstatement due to fraud or error. Other procedures may be performed to assist in the auditor's assessment of the risk of material misstatement. Information such as those obtained from external sources such as a predecessor auditor, analyst, and regulatory publication may strengthen the auditor's understanding of the entity and its environment to assess the risk of material misstatement. In here, we have an illustration of the role of risk assessment procedures. Collectively, the performance of risk assessment procedures is designed to help the auditor obtain an understanding of the entity and its environment, including the entity's internal controls, for the purpose of assessing the risk of material misstatement when planning the audit. However, risk assessment procedures do not provide sufficient appropriate audit evidence to form an audit opinion on the financial statements. You can find Figure 9-1 on page 264 of your textbook. On the next slide, we will discuss the auditor's consideration related to the risk of material misstatements due to fraud. Risk assessment procedures include assessing the risk of material misstatement due to fraud or error. The auditor's consideration of fraud risk is made at both the financial statement level and at the assertion level for classes of transactions, account balances, and presentation and disclosures. Because a number of high-profile cases of financial statement fraud involve misstatements in revenue recognition, auditing standards require the auditor to presume that risk of fraud exists in revenue recognition. As a result, risks related to audit objectives for revenue transactions and their related account balances and presentation and disclosures are presumed to be significant risks in most audits. If the auditor determines that the presumption is not applicable to a particular audit engagement, the auditor must document his or her conclusions in the working papers. Moving on, we will now cover the auditor's responsibility to identify significant risks. As part of the auditor's assessment of the risk of material misstatement, whether due to fraud or error, auditing standards require the auditor to determine whether any of the risks identified are, in the auditor's professional judgment, a significant risk. Significant risk represents an identified and assessed risk of material misstatement that, in the auditor's professional judgment, requires special audit consideration. Significant risks often relate to non-routine transactions, which represent transactions that are unusual and that are infrequent in occurrence, such as related party transactions. Account balances or transactions that require estimates for which significant measurement uncertainty exists may also require more audit attention. As a result, when auditors identify a potential risk of material misstatement due to fraud, auditing standards require that the auditor to consider that risk as a significant risk. On the next slide, we will discuss about the audit risk model and its components. The risk of material misstatement at the assertion level consists of two components: inherent risk and controlled risk. Auditors consider this risk by applying the audit risk model. The audit risk model helps auditors decide how much and what type of evidence to accumulate for each relevant audit objective. The audit risk model is usually stated as the planned detection risk being equal to the result of acceptable audit risk over inherent risk times control risk. You can find the audit risk model formula on page 269 of your textbook. In here, we have an illustration of the relationship between the audit risk model and the understanding of the client's business and industry by the auditor as discussed in Chapter 8. Auditors use the audit risk model to further identify the potential for misstatements in the overall financial statements and at the audit objective level for specific account balances, classes of transactions, and disclosures where misstatements are most likely to occur. You can find Figure 9-2 on page 269 of your textbook. In here, we have an illustration of how the auditor might begin by considering risks at the transaction cycle level. The auditor will also consider differences in risk levels across various audit objectives within an individual class of transactions. The first row in the table shows the differences among cycles in the frequency and size of expected misstatements. Almost no misstatements are expected in payroll and personnel, but many are expected in inventory and warehousing in this particular example. It is possible that the payroll transactions are routine while considerable complexities exist in recording and valuing inventory. The second row in the table shows internal control differ in effectiveness among the 5 cycles. For example, internal controls in payroll and personnel are considered highly effective in this particular example, whereas those in inventory and warehousing are considered ineffective. The third row of the table shows that the auditor has decided on a low willingness that material misstatements exist after the audit is complete for all 5 cycles. It is common for auditors to want an equally low likelihood of misstatements for each cycle after the audit is finished to permit the issuance of an unmodified opinion audit report. These considerations, which are A, B, C on the table, affect the auditor's decision about the appropriate nature, timing, and extent of evidence to accumulate, as seen on the last row of the table, which is D. For example, because the auditor expects few misstatements in payroll and personnel, and internal controls are effective, the auditor in this particular example plans for less evidence than for inventory and warehousing. Note that the assessments in Table 9-1 are not in numerical form. Although risk model assessments may be quantitative or non-quantitative, most CPA firms prefer non-quantitative assessments of risk, such as the use of low, moderate, and high, due to the difficulty in precisely quantifying measures of risk. Please read Table 9-1 on page 270 of your textbook. Each of the 4 risks in the audit risk model is sufficiently important to merit detailed discussion. We will briefly discuss all 4 to provide an overview of the risks. Planned detection risk is the risk that the audit evidence for an audit objective will fail to detect misstatements exceeding performance materiality. Planned detection risk is dependent on the other 3 factors in the model. It will change only if the auditor changes one of the other risk model factors. In contrast, inherent risk measures the auditor's assessment of the susceptibility of an assertion to material misstatement before considering the effectiveness of related internal controls. Such assessments are based on discussions with management, the knowledge of the company, and results in audits of previous years. Control risk measures the auditor's assessment of the risk that a material misstatement could occur in an assertion and not be prevented or detected on a timely basis by the client's internal controls. Acceptable audit risk is a measure of how willing the auditor is to accept that the financial statement may be materially misstated after the audit is completed and an unmodified opinion has been issued. Often, auditors refer to the term audit assurance instead of acceptable audit risk. Audit assurance, or any of the equivalent terms, is the complement of acceptable audit risk. Moving on, we will now discuss assessing acceptable audit risk. Auditors must decide the appropriate acceptable audit risk for an audit. Auditors must first decide engagement risk and then use engagement risk to modify acceptable audit risk. Engagement risk is the risk that the auditor or audit firm will suffer harm after the audit is finished, even though the audit report was correct. Engagement risk is closely related to the client's business risk because the risk that the auditor will be sued is often related to the business failure after the audit is finished. Client business risk was previously discussed in Chapter 8. Research points to several factors affecting engagement risk and therefore affecting acceptable audit risk. We will discuss 3 of those factors. The first factor is the degree to which external users rely on the financial statements based on the client size, the distribution of ownership, as well as the nature and amount of the client's liabilities. The second factor is the likelihood that a client will have financial difficulties after the audit based on liquidity position, profits or losses in previous years, the method of financing growth, the nature of the client's operations, and the competence of management. The third factor is the auditor's evaluation of management's integrity. If a client has questionable integrity, the auditor is likely to assess a lower acceptable audit risk. In here, we have an illustration of the methods used by auditors to assess each of the 3 factors already discussed. After examining Table 9-2, it is easy to observe that the assessment of each of the factors is highly subjective, meaning overall assessment of acceptable audit risk is also highly subjective. A typical evaluation of acceptable audit risk is high, medium, or low, where a low acceptable audit risk assessment means a risky client requiring more extensive evidence, an assignment of more experienced personnel, and or more extensive review of audit documentation. As the engagement progresses, the auditors obtain additional information about the client, and acceptable audit risk may be modified. Please read Table 9-2 on page 275 of your textbook. On the next slide, we will cover assessing inherent risk. Assessing inherent risk is an attempt by the auditor to predict where misstatements are most and least likely in the financial statement segments. This information affects the amount of audit evidence that the auditor needs to accumulate. The auditor must assess the factors that make up the risk and modify procedures for audit evidence to take them into consideration. This consideration takes place during the planning phase and is updated throughout the audit process. The auditor should consider the following factors when assessing inherent risks: the nature of the client's business, the results of previous audits, initial versus repeat engagement, related parties, complex or non-routine transactions, the judgment required to correctly record account balances and transactions, the makeup of the audit population, factors related to fraudulent financial reporting, and factors related to misappropriation of assets. Moving on, we will discuss the relationship of risk to audit evidence and the factors influencing risk. Auditors respond to risk primarily by changing the extent of testing and types of audit procedures. In addition to modifying audit evidence, the auditor can also make the following changes to respond to risk: requiring more experienced staff to be involved in the audit engagement, and reviewing the audit engagement more carefully than usual. In here, we have a summary of the factors influencing risk and the relationship of risk to planned audit evidence. As can be seen in this figure, there are several factors that influence acceptable audit risk, inherent risk, and control risk. The three-component audit risk affects determination of planned detection risk. There is a relationship between acceptable audit risk, inherent risk, control risk, and planned detection risk to planned audit evidence. D in this figure indicates a direct relationship between a component risk and planned detection risk or planned evidence. I in the figure indicates an inverse relationship. For example, an increase in acceptable audit risk results in an increase in planned detection risk and a decrease in planned audit evidence. Compare Figure 9-3 on page 278 of your textbook to Table 9-1 on page 270, and you will observe that these illustrations include the same concepts. The risk of material misstatement, control risk, and inherent risk are assessed for each audit objective in each segment of the audit. The assessments are likely to vary on the same audit from cycle to cycle, account to account, and objective to objective. In Chapter 8, the process of allocating the preliminary judgment about materiality to segment was previously discussed. Although it is common in practice to assess inherent and control risk for each balance-related audit objective, it is not common to allocate materiality to those objectives. One major limitation in the application of the audit risk model is the difficulty of measuring the components of the model. To offset this measurement problem, many auditors use broad and subjective terms such as low, medium, and high. In here, we have an illustration of the relationships of risk to evidence. As the table shows, auditors can use the risk measurement of low, medium, or high to decide on the appropriate amount and types of evidence to accumulate. For example, in situation 1 in this illustration, the auditor has decided on a high acceptable audit risk for an account or audit objective. The auditor has concluded a low risk of misstatement in the financial statement and that internal controls are effective. Therefore, a high planned detection risk is appropriate. As a result, a low level of evidence is needed. In contrast, situation 3 is at the opposite extreme of situation 1. If both inherent and control risks are high, and the auditor wants a low acceptable audit risk, considerable evidence is then required for the audit. The other three situations fall between these two extremes. In applying the audit risk model, the auditors are concerned about both over-auditing and under-auditing. Most auditors are more concerned about the latter, as under-auditing exposes the CPA firm to legal liability and loss of professional reputation. Because of the concern to avoid under-auditing, the auditors typically assess risk conservatively. Auditors develop various types of decision aids to help link judgments affecting audit evidence with the appropriate evidence to accumulate. Such decision aids are evidence planning worksheet. The audit risk model is primarily a planning model and is therefore of limited use in evaluating results. If audit evidence suggests that the risk is higher than originally thought, the auditor must revise the original assessment and consider the effect of the revision on evidence requirements. In here, we have an illustration of an evidence planning worksheet to decide test of details of balances for Hillsburg Hardware Company. The 8 balance-related audit objectives introduced in Chapter 6 are included in the columns at the top of the worksheet to help ensure the auditor considers risks related to all the relevant balance-related assertions. Rows 1 and 2 are acceptable audit risks and inherent risks. Performance materiality for accounts receivable in this illustration is included at the bottom of the worksheet. You can find Figure 9-4 on page 281 of your textbook. On the next slide, we will discuss how materiality and risk are related and integrated into the audit process. The concepts of materiality and risk in auditing are closely related and inseparable. Risk is a measure of uncertainty. Materiality is a measure of magnitude or size. Taken together, they both measure the uncertainty of amounts of a given magnitude. For example, the statement that the auditor plans to accumulate evidence such that there is only 5% risk of failing to uncover misstatements exceeding performance materiality of $265,000 is a precise and meaningful statement. If the statement eliminates either the risk or materiality portion, it is meaningless. A 5% risk without a specific materiality measure could imply that a $100 or $1 million misstatement is acceptable. A $265,000 overstatement without a specific risk could imply that a 1% or 80% risk is acceptable. In here, we have figure 9-5 that expands the illustration on figure 9-4 by including performance materiality. Observe on this figure that performance materiality does not affect acceptable audit risk, inherent risk, control risk, and plan detection risk. Each of the 4 risks have no effect on performance materiality, but together they determine planned evidence. Stated differently, performance materiality is not part of the audit risk model, but the combination of performance materiality and the audit risk model factors determines planned audit evidence. We have reached the end of the discussions for Chapter 9. We have covered during this presentation the audit risk model and performance materiality. The audit planning requires effective assessments of the risk of material misstatements at both the overall financial statement level and at the assertion level. Using the audit risk model and performance materiality for each audit objective, the auditor determines the audit evidence needed to achieve an acceptable level of audit risk for the financial statement as a whole. Please complete the required evaluation method for Chapter 9 as it will be part of your final grade. The comprehensive problem is to be submitted on the specified due date. Please use the comprehensive problem module in Blackboard for instructions and requirements. You have reached the end of the course presentation for Chapter 9. Please access the video for Chapter 10 for the next presentation of the course.